Morning, everyone, and thank you so much for joining us today for the webinar series on fixed indexed annuities. I'm Julie Stewart, the Annuity Director here at the Milner Group, and over the last several months, we have been tackling topics with regards to retirement planning and how annuities fit into that. We've gone over Annuity 101, which is the fundamentals, the types of annuities. We've reviewed suitability, and then now we're on to product design. The goal is to bring you the information in a clear and concise manner to assist you with building your knowledge base. So if you haven't already, I strongly encourage you to go to youtube.com and then over to the Milner Group channel to watch the previous webinars. They will definitely give you a better handle on the purpose and design of annuities and how they fit into retirement planning. So I also want to mention that we do have the ability to respond to questions during the live webinar, so feel free to use the chat box on the right of the screen. You can type questions right in there, and at the end I'll take a look and see if there's anything we can just answer in the moment. As always, the Milner Group is here to assist you with all levels of planning and lines of insurance, from fully underwritten and simplified issue life insurance, Medicare, disability, long-term care, and annuities. So definitely remember to view us as an extension of your practice. We're here to give you the tools and resources to be successful in the field and to make sure that you're not leaving any money on the table. All right, so diving right in. When your clients determine that they are more conservative in investment thinking, indexed annuities can help to protect and grow their hard-earned money in a positive manner with very little risk. Annuities are generally sold to people at or near retirement age, and although we are definitely starting to see a trend of the younger demographic looking at indexed annuities because they protect them on the downside and they do have a really great potential for growth. So part one of the series, we discussed the features of the indexed annuity, how they're structured, and how they credit interest. Today we're going to focus on income riders. Income riders will provide assurances in retirement in the form of guaranteed income, which cannot be outlived and can be shared between spouses, covering both lives. So there's joint income options available. So what is an income rider? Well, at its core, it's going to provide a lifetime stream of income. It's just an optional provision that is added to the base contract of an indexed annuity. It can provide, in addition to income, an enhanced death benefit or long-term care-like features. There typically is a rider charge associated for adding an income rider, and that is charged to the account value every year. Generally speaking, I would say those fees hover around 1%. Generally, this income rider is elected at issue. The majority of carriers at the time of application require the client to say whether or not they want the income rider. Right now, there's only one carrier that will allow the income rider to be added after the policy is in force. So it's important to understand that. An income rider which guarantees income is not the same as annuitizing an annuity. That's something different, and I certainly can answer questions on that, after the fact. And most importantly, and what I think clients really gravitate towards, is that adding an income rider allows your client to retain access and control over the account value, which is their real money. There are other annuity product types, such as a single premium immediate annuity or a deferred income annuity, that the client actually loses access and control to the account value. So indexed annuities allow them to maintain that access, which gives them a lot of options going down the line. So why do income riders matter? Well, guaranteed retirement income is definitely key. Income riders will help protect against the risk of outliving one's money, which is the biggest fear in retirement. With increased life expectancy and medical science, our seniors are facing a longer retirement. Social Security and pensions have to be squeezed to stretch out to last for a longer time period, and it's often very difficult. And the income riders really can help protect against the risk of longevity. So the fastest growing demographic in the United States are those over the age of 100. which is really something astounding if you think about it. I mean, the fastest growing demographic are people over the age of 100. So again, a lengthy retirement is a very real risk and something that we need to plan for, as it can last, for 20 to 30 years. So index annuities, again, with the income riders, will offer a way to guarantee a portion of retirement income not seen in other products. And interestingly, Allianz, who's a pretty big index annuity and income rider carrier, did a survey, and 61% of participants said that they feared outliving their retirement money more than they feared death. So as planners and benefits coordinators, you really have an opportunity to get in there and show them ways in which you can help them protect and guarantee an income stream to last no matter how long they live. So let's take a look at how the income rider works. When an income rider is attached to an indexed annuity, there is a rider charge, and it essentially creates two buckets within the contract structure. You have the account value and the income value, and they are separate from one another in the majority of designs. Now, the income value can only be accessed by turning on the income stream. It cannot be taken as a lump sum. So it is important to understand what your client's financial objectives and time horizon for needing income really is when you're meeting them. Because at the end of the surrender charge schedule, or the length of the term of the contract, if they decide that they want to walk away, they are not walking away with the income value. They are walking away with the account value. So it's important to keep that in mind. Now, the income amount that they will receive is determined by the age of the client and the length of deferral. The longer the deferral period, the higher the payout factor, which just equals more income. Now, we do have income riders that can provide income immediately or income later on, 5 years, 10 years, 20 years. Again, there are excellent products that the longer they defer it, the more money they will realize, and it will be fully guaranteed and locked in for the rest of their lives. So once the policy is in force, the client can determine when to turn the income on. Some contracts, again, will allow access immediately, but other contracts require a 1 or 2 year deferral before the income stream can be switched on. So again, just understanding, what the client objective is and when they need access to that income. Joint payouts are also available for spouses. Typically, the payout will decrease when you're covering joint lives, but really, you're covering 2 lifetimes, so the policy will, absolutely ensure that money is always there. So what we're looking at now is an illustration page. We feel it's important to understand how to look at this type of information and then show it to your client. So this is an example of a male age 65 with a $100,000 deposit. This ledger page is showing the guaranteed income rates assuming 0 growth to the base contract. So this is just the contract guarantees. They put in $100,000, and no matter what happens, this contract guarantees these income payouts. So the first green arrow you see to the left is showing the account value. So they put in $100,000. This particular product has a bonus, so that's the account value. That's the walkaway value. If they wanted to surrender or whatever, that's the value that they're getting. The next column, or the third from the last, is called the EGMWB, income base, and this is the income account value. The column next to that is the payout factor. So, for instance, in year 1, they deposit $100,000. Their income account value is immediately guaranteed to be worth $114,223. If they were to turn on income, they would pay it out at 4.85%, and that would generate a guaranteed stream of income at $5,540. So, as you can see, the longer they defer it, the longer that payout, the payout percentage will climb. So in this example, if your client says, you know what, I have $100,000, I don't need income now, but I'm probably going to need it in 10 years, you can show them without a shadow of a doubt that if they were to invest in this product, at the end of the 10th year, their income account value is guaranteed to be worth $205,619. They would lock in a payout factor of 5.75%, and it would generate an annual income of $11,823 for the rest of their lives. So even, let's say that they, this guy's 65, let's say he lives till he's 97, which is very likely, the account value will eventually go down to zero. But the income value, no matter what happens to the account value, the income value will continue to pay for his entire life, whether he lives to 110, it doesn't matter. It will continue to pay. That's a contractual guarantee. So that in a nutshell is kind of how we review this page. This is based on contract guarantees. So now, how does the income value grow? Well, there's definitely a few ways that it can grow, or actually there's really two ways. You have, the first way is via a guaranteed roll-up rate. The rates are anywhere from 4 to 7%, and that can be either simple or compound interest, which is an important distinction. And the roll-up can last anywhere from 10 to 20 years. This is the most popular option, and that's because what we find is that consumers like to know exactly what they can anticipate. But as I said, some carriers will do simple interest, others will do compound. Depending on your client's time horizon, if they say they need income in 10 years, we're going to want to maximize the roll-up and get them a product that has the best roll-up rate over those 10 years. But if somebody says, well, I might not need income till, the 12th year or maybe in 15 years, well, then we want to make sure we match them with a product that will continue to grow that income bucket for up to 20 years or until they execute income. So again, it's just important to understand that time frame. So the second way that the income value can grow is with stacking income credits. So stacking income credits is the roll-up rate, which is typically reduced, plus the underlying interest that is earned on the account value stacked on top. This actually offers a higher potential on the income value. So to kind of break it down, let's say that we're looking at a product that has the income stacking credits, and the roll-up rate is 4%. So, at the very minimum, the client will get 4%, but any interest that is earned on the underlying account will be stacked on top. So if they earn 5% on the account value, that's a total of 9% that would be stacked onto the income value. So as you can see, there's a much greater opportunity for growth there. Most carriers are gravitating towards the stacking income credits. We definitely have some carriers left that still do the guaranteed roll-up rates, and as I said, that is really the most popular option from a consumer standpoint. However, more and more carriers are moving to the stacking income design, so it is important to understand how it works and to just be able to talk about it with ease. So this next slide is really just kind of highlighting how the roll-up rate works, and I forgot to mention that some carriers do have increasing income payout options. So typically when you turn on the income, it's a level payment guaranteed for the rest of your life. So on the F&G slide, we looked at $11,200 every year guaranteed for the rest of their lives. But there are a few carriers that say, well, we'll guarantee that that's the minimum, but there is a potential for each payout to increase over the life of the contract. And each carrier that offers that, they calculate it in a different manner. So this particular slide is showing us a product from AIG, which has an increasing income payout option. So in this scenario, the client is age 60 with a $100,000 deposit. The income rider is guaranteed to grow based on 7% simple interest every year for the first 10 years or until income is turned on. So in this instance, you see the income value adds 7% every year, and then in year 6, the client decides she wants to turn the income on. So what happens is the client starts to begin to receive her withdrawals, which is paying her out at 5%. But this will continue to grow her income value by 2%, which is the difference between the income credit she was receiving at 7% minus the payout withdrawal factor. So essentially each year after she executes it up until the 10th year, AIG will give her the difference between the roll-up rate and the payout factor as a way to ensure that she's going to see some increases until at least the 10th year. So this is definitely a popular product option because clients like to know, okay, well, I'm going to lock in, let's say at $10,000 a year, but this is going to add 2% every year until the end of the 10th year. So it's just ensuring a way that they're kind of having the ability to keep pace with inflation. So if you have any questions about that, definitely give me a call and we can just have a one-on-one conversation about increasing income options. So now that we've looked at the income rider and how the income rider credits interest or how the income bucket grows, and then how your clients can take income out, we're going to talk about wealth transfer. In some cases, with some income riders, the income rider is also the death benefit. So there are some carriers that will allow the income rider to actually pay out as the death benefit. So why is that attractive? Well, typically, the income value is the highest value in the contract. The account value is growing, but it's also having the fee deducted. And typically, the income value, has a really nice roll-up rate, or those stacking interest credits, and it's just a much larger value. So there are a few select carriers that will allow the income rider to pay out to the beneficiary at death. So it's just a nice added benefit. Now, if your client is only interested in enhanced death benefit, maybe they can't be insured for life insurance, they can actually just add an enhanced death benefit rider. So we understand, how the income rider grows. Well, if you're just adding an enhanced death benefit rider, it's going to grow in the same manner via the roll-up rates. So if you're adding an enhanced death benefit rider, it's going to grow with stacking credits, which would be, with a roll-up rate that would be credited each year. Now, unlike life insurance, it's important to understand that death benefit proceeds from an annuity are taxable, and the amount of taxation depends on the tax status of the funds, whether they're qualified or non-qualified. So if it is the income rider that's going to pass at death, as I had said, we understand how that is going to grow, either roll-up or stacking income, and then if it's the rider, we know that that's going to roll via the roll-up rate. The death benefit can be paid via lump sum or over a period of time, and there's even a way to show your clients that the death benefit can grow even when they're taking their RMDs, which is on qualified dollars, and RMD stands for required minimum distribution. So this illustration is just showing how the death benefit feature works. So under the first arrow, you're seeing that in this instance, they're getting a specific roll-up rate that's going to credit $8,000 a year every year for 10 years. The death benefit base, this is contractually guaranteed, so they deposit $100,000. By the end of the 10th year, the death benefit is guaranteed to be no less than $180,000. And then it shows you, the last two columns show you how the death benefit can be taken. So they can either take the entire death benefit amount, so the $180,000 in this instance, over 5 years, or they can take it via lump sum at a reduced amount. Now, when you're dealing with qualified dollars, spreading the death benefit out over 5 years is the best option because it'll spread out the tax liability for the heir. So it's really just a better way to not only leave a lasting legacy, but make sure that they're not going to be, receiving this massive taxable event, if we're dealing with qualified dollars. And then finally, the income rider also can provide long-term care-like benefits. So some income riders will actually double or even triple the income payout if the client becomes confined to a nursing home. So this is really known as a confinement benefit. Typically, the doubling or the tripling will last up to 5 years, and there usually is an elimination period. So the contract has to be enforced 2 or 3 years, depending on the carrier, before they can access the nursing home feature. But this is just another added benefit. So you can tell your clients, it's kind of a peace of mind thing. Like, there's no additional charge for it in a lot of the products. If they're adding the income rider, they get a nursing home doubler, for free, basically, and it really can help them if they do become confined. Now, there is one other product that has what's known as a well-being benefit, and that doubles the income bucket if the client is no longer able to perform 2 out of 6 ADLs. The major difference here is that the well-being benefit covers care in any setting. So if your client is going to receive home health care, they can execute this doubling and receive payments to pay for care at home. And oftentimes, that's a pretty big deal for clients, knowing that they, a lot of times when people go on claim, they don't require round-the-clock confinement. They may need rehab, adult daycare, or assisted living, or maybe just a home health aide to come in a couple times a week to help them. Well, if you attach what's known as a well-being benefit, it will pay for care in any setting. And it's really just a great option for those who maybe can't qualify for traditional long-term care or the asset-based long-term care. And this is how that illustration looks. So essentially, it's really just an income calculation. What we're showing you here at the top is that the rider name is the lifetime income benefit and well-being, so it's showing that the well-being is included. Down under the lifetime income benefit payment column, that's what's showing you what their income payment would be annually. Now, if they were unable to perform 2 out of 6 activities of daily living as certified by a physician, that income payment would double for 5 years. And again, that's providing them with an additional benefit to help them cover the cost of care. Now, with this particular product, it must be enforced for 2 years. So again, these are just product features that you need to be aware of. Typically, if they're adding an income rider, there can be a long-term care kicker, and usually the long-term care kicker requires an elimination period of 1 to 2 years. So this concludes really our look at income riders, how they grow, and the additional benefits that they can provide. So just kind of tying it up, index annuities offer income riders that have the ability to provide income immediately or at some time in the future. The income riders can also provide a wealth transfer strategy by way of enhanced death benefit, or they can provide a long-term care kicker. So should you have any cases that you're currently working on that you'd like to discuss, please feel free to give me a call directly at 770-558-8904. If you have any questions, I'll actually just look to see if there's any questions. Okay, it doesn't look like there are any questions. This will be posted on YouTube. Again, it's a high-level overview of how the income rider works and really what it can do. It can provide income, it can provide death benefit, and it can provide some sort of long-term care kicker coverage. If you have any questions, as always, give me a call. I do appreciate your time, and I hope you all have a great weekend.